And this is episode 2 of me teaching you exactly how to trade, exactly how I do it. Well, it's not exactly how I do it, but it's based on the same core concept of long-term profitable retail trading. So last time we already spoke about how we're going to approach risk management, how we're going to do stops, how we're going to do targets, blah, blah, blah. So let's get right into the strategy part of this video because it's super simple. Literally anybody that has, any basic knowledge on trading can incorporate the system into their live testing, into their back testing, into whatever the hell you want to do with it. All you have to know is basically what a downtrend is, what an uptrend is, and what a consolidation is, right? This is extremely simple. I know that all of you guys probably already have this basic technical knowledge. Another thing you have to know is what the retail technical term for a supply or a demand area would be and how to market. So in an uptrend, you're going to do something like this. So we're marking areas in price, just before the price pushes up, breaks previous market structure, having that great power in, towards the trend direction, and then slowly pushing back into that area, right? So these are levels of demand because they are in a bullish trend, and vice versa would be for a supply scenario, right? So that's going to be the basic knowledge required to understand this video, what a trend is, what a consolidation is, what a supply and demand area is. And for the fun of it, what we're going to do is we're going to add a technical indicator. At this time, I chose the RSI, or the relative strength index. When the level of that indicator reaches 30 is going to give us a buy signal, and vice versa when it reaches the 70 level, which is the sell signal. Those of you who are a little bit older or a little bit longer, in the game will remember that before all of this ICT, SMC, supply and demand stuff, the RSI indicator was actually the popular thing for the beginners to know, right? So in this video, I already have an example set up. I have a couple of supply levels drawn up in this very bearish market situation for the 1 hour chart on the Australian dollar US dollar forex pair. And this is how this looks like, right? Price pushing down, there's a supply level because the price broke previous structure, and again and again and again the same thing. It's like a staircase pattern. Most of you already know that. Don't mind how these levels are drawn. Of course, everybody has their own way of drawing them. Some use the last candle before the push down, some use the whole cluster of candles or whatever. I just marked this, kind of whatever, just went with the flow. And this is where things are going to get a little bit more interesting, right? So in the last video, we determined that we're going to be targeting a 1 to 2 in risk to reward. So that means for every unit of capital we risk, we want to get 2 units in return if the trade is a winner. So this is an example of a 1 to 2 trading example, right? But here's the big question. This has already happened, right? Obviously, this is already printed. The candles are already here. So how would I know where to place the stops, where to place the profits? The targets, of course, to not get, taken out, even if the trade direction is correct. And that's exactly the main question when it comes to trading, right? Because obviously, a lot of the times you can predict or determine the direction of where the price is going to go, but you don't know where to enter. You don't know where to put your stops. You don't know where to put your targets to have an optimal system. And in this video series, that's actually what we're going to learn. So starting off with this example, obviously, there's a supply level right here. Price retraced towards that supply, meaning we are in a downtrend market. We're looking for sells, and the RSI level hit the 70 mark, which is another indication that we can open a short position. But like I said before, we don't know what that means. We don't know, except the entry is going to be here. Where are the stops? Are the stops just above here? Are the stops above here? Are here? Whatever, because as the stops move, grow, shorten, or whatever, also do the profits, right? Because if we have large stops, we also need large take profit targets. And when that happens, we also require more time for the trade to be completed. So this is kind of the point on why we journal, so we can then later optimize and see if what we're doing even makes sense. For this example, for this strategy, what I'm going to do is I'm going to do, I don't know, a 50, 60 stop, pip, of course, and I'm going to do 1 to 2, right? So something like this would be 120 pips in profits, 120 and 60 pips for the stop targets, right? And in this very example, if we don't set break-even targets, if we don't take partials, this would have been a winning trade. But this particular example does not matter. What matters is what's going to happen in the next 50, 100, or 1,000 trades that I take. Is this even something that makes sense? Or is this something that will completely flop because the win rate is just not going to go through? And that's what we're going to see in the next video. I'm not going to do a live test because there's no time for me to do 50 or 100 trades and present you the data, but I'm going to do a back test. I'm going to show you how this system performed on, let's say, this pair, or whatever other asset that I'm going to test it on. But you can do some testing on your own. This is a very, very simple strategy, but the strategy isn't even the point. The point is that we're trying to do a 1 to 2 in risk to reward, and we're hoping for a 40 to 50% win rate. Maybe 50, a little bit of an over exaggeration, but a 40% would sound just about right. So we're looking for a trending market. We're looking for an area of supply and demand, and if the price retraces to that area, we're looking for an RSI confirmation, right? So I'm not sure what type of frequency this system will provide. Maybe it's 1 trade per month, maybe it's 1 trade per week, maybe it's 1 trade per day, right? And of course, depending on what assets are we following, what assets are we trading, is going to be a lot of data to go through, a lot of testing has to be done. But that's the point of trading. That's what trading really is. And once you have all of that data, once you know what you're doing, once you have the probability, once you know the expectancy, once you know how often you lose, how often you win with a very specific set of rules, that's when you actually start being a trader. Until then, all we're doing is playing with data, testing, and evaluating. People are going to say, oh, why just not put stops above this area? Sure, you can do that. Feel free, test it out. Do something like this. This is the entry. Here are the stops. It's a 1 to 2, something like this. Just test it out. Test it out over 100 trades. Tell me what happens. This particular example does not matter. This is just a visual example of what a trade with this system would look like. This particular trade would be a loss, but perhaps in the next 100 or so trades, you're going to achieve a 40 or 50% win rate anyway, right? Maybe you could even extend the profit targets. Maybe you could do a 1 to 2.5. Maybe you could do a 1 to 3, right? Test it out, journal data, collect data, optimize the system throughout that sample. Once you have the trades locked out, just play around with the stop targets, with the profit targets, and very quickly, you're going to see what makes sense over a larger example and what does not make sense over a larger example. This is as simple as it gets, people. Trading is not a complicated business. It is extremely simple. You don't need fair value gaps, divergences, imbalances, all of that crap. All you need is a very, very simple system that is backed by data, that is backed by math, and you can make money trading, right? But forget about the millions of dollars and hundreds of thousands of payouts from prop firms. Forget about Lamborghinis. That is not what trading is. That is a false advertisement from YouTube gurus trying to sell you something. This is what trading looks like. Developing a system, testing that system over larger samples and periods, collecting data, optimizing that data to fit real life situations, and build up expectancy. That is what trading is. And in the next video, we're going to continue doing exactly that. Like and subscribe, bitch.